To be honest with you, I'm going to be brutally honest. I thought exactly the same when I first began trading. I thought trading was just about buying and selling, learning a couple of candlesticks, and then being in a position where I can repeat this process again and again and again. I mean, I've spent 3 years studying price action before I even saw my first penny out of the markets. Spent 3 solid years believing that just learning technicals will be enough for me to start making money. And I was very, very far away from the truth. Trading is a performance based activity, just like playing sports. And you need to be in a position where you're not only performing, but you also need to study your mindset. And behind your mindset, you also need to study your behaviors. So, hence the reason why we say that trading is potentially anywhere between 80 to 90% psychology, because it's really and truly your headspace that controls how well you're going to perform in these markets. Patterns are patterns. You know, the market will statistically repeat itself. We very much know that from Mark Douglas, trading in the zone. However, can you behave when these patterns turn around? If you do take a loss due to probability, are you in a position to hold yourself back, or instead of revenge trading or trying to claw the money back? Or are you going to be in a place where, whilst you are losing money, you add more to your positions, doubling down and so on and so forth? So these are all psychological battles that we face as traders. So it's extremely difficult to just say that trading is just about trading. It's more about us than it is about the markets. Very good question. Consistency is a matter of collecting data, collecting information as soon as possible. Now, there is tons of information out on the internet, and it's all piecemeal. So it makes it very hard for the beginner trader to actually understand what they're meant to be looking for, how they're meant to look for it, and third of all, how they're in a position to actually gain some sort of stats out of it. So first of all, let's break down the word consistency. Consistency is doing the same thing again and again and again, irrespective of the outcome. So, as traders, we very much know that if we have a strategy or we have a system, we repeat the behaviors that go behind that system to enable it to perform. And irrespective of the outcome, we're going to keep doing the same thing again and again and again. And then over a large sample size, over a large amount of trades, we can then say that this system performs at an 80% win rate, 70% win rate, 40% win rate. It doesn't matter as long we are consistently doing the same thing. But what happens with the beginner mindset is that we're too focused on making money than we are on consistency. Therefore, we go after the pips, we go after the dollar amount, instead of going after a strategic approach that we can repeat and then eventually scale. Think about it. Just like any shop, they're not constantly changing their products. They have a set of products that do very well and they keep selling them. Eventually, what happens, they open another shop, then open another shop, then open another shop. That's scalability. That's what we want to do as traders. Having one strategy that enables us to keep scaling our accounts. Because at the end of the day, whether you're doing the work with 500 quid or 500,000 quid, it's the same system, the same approach. The only thing that changes is the dollar amount. Focusing on the monetary value as a beginner trader is probably the biggest mistake you can do. Many reasons for that. First of all, we don't know how to disattach ourselves from the outcome at the beginning of our trading career because we just don't know how to do it. We haven't been taught to detach yourself from the outcome. So looking at your P&L, it's an automatic, you could say, it's an immediate feedback to your performance, which is going to be quite hurtful. I mean, I remember being a beginner and just seeing a sea of reds, losing after like 10, 20 trades, loss after loss after loss after loss. That's going to demoralize you and make you think that trading is not for you. And that's not really the case. You just haven't learned your style. You haven't gone through a sampling stage. You don't know what strategy works for you. And you don't know what kind of strategy works for your personality. So your P&L, or looking at the monetary value at the beginning, is potentially the worst thing you can do as a trader. What you want to do is judge yourselves on pattern recognition. What do I mean by that? Do I keep finding the same setup? Do I keep seeing the same pattern in the market that enables me to take advantage of it? Or am I just trading for the sake of trading? Therefore, waking up, seeing something bouncing off a moving average, or just seeing just a huge candle and just trading the back of it? Or am I actually looking for something that I can genuinely recognize and keep trading again and again and again? Once you get to a stage where you got that pattern recognition, then you want to go into my behavioral patterns. When this pattern arises, am I in a position to actually behave in the sense of trade when I need to trade, not jump the gun, not enter too late and not exit too early, and so on and so forth. Once you have those patterns unlocked, then you can start looking at the monetary value as another metric of performance. But at the beginning, you don't want to. Learn how to um, learn how to find your patterns, and then learn about yourself to make the most out of the markets when an opportunity is given to you, and then look at the money eventually as another metric. Yes, you are. Absolutely. Data is everything. So think of yourself as a business. A business without an accountant can't call themselves a business, because they don't know where their money is going. They don't know where their money is flowing to. They don't know what they're buying. They don't know what they're selling. They don't know what their money's been invested into. So they can't really call themselves a business. So think of yourself as a trader now, and you're not collecting any data whatsoever towards your trading. Well, yeah, you could be making money, but how are you making that money? Are you just scalping for the sake of scalping? Do you even know if scalping is the best way for you to trade? You know, honestly speaking, I cannot take you seriously as a trader if you're not collecting any information. The information is there to better you. First of all, the information is a mirror of yourself. How do you trade and what do you need to improve on? You know, and if you're in a position where you're not collecting any information, you don't know where you stand. You don't know your weaknesses, you don't know your strengths. And without that, you can never develop. This game is self mastery and constant development. And the only way that you're going to get there is through collecting data, collecting information, journaling, your metrics behind your trades, and then the screenshots, and so on and so forth. This enables you to sharpen your sword when it comes to trading. And if you're not doing so, you're going to be struggling for years. I mean, I remember at the beginning of my trading career, I didn't collect any data either, you know, and I think I wasted 2 years of my trading career not doing so because I wasn't picking up patterns quickly. Whilst if I collected that information from the beginning and instill that habit from the beginning, I'll probably be way more ahead now than I would have been. Okay, so what specific data would I recommend? Well, first of all, you're gonna get your basics from your trading panel or your charting software, which is your entry, your exits, and how long you were in the trade per se. But the information behind that is, first of all, the context behind the actual trade itself. Are you a trend-based trader? Are you a reversal trader? Only you know that because you know how to analyze the market, or you're looking to analyze the market in a certain way. Second of all, how did you feel within that trade? I'm not saying that your feelings are everything when it comes to trading, but they play a major role, because eventually, especially at the beginning of your trading career, you shouldn't really be trusting your feelings because you're lacking the information to show the pattern recognition. Once you've developed that pattern recognition and you've got the data to say that, hey, look, I'm a reversal trader, and out of all the reversal trades that I've taken, 6 of them went in my direction, 4 of them didn't, then you can start saying to yourself that, hey, you know what? I'm actually pretty good at this. And then the 6 that did go in my direction, how far did they travel? Did I do 1%, 2%, 3%, 4% return? Now you can start actually judging your win rate, which leads you to a place where psychologically you can say to yourself, I don't need to be right on every single trade, but if I focus on this specific pattern, I'm going to be okay in the long run because my wins outweigh all my losses. And then it also comes to a fact of performance. Okay, great. I took 20, 30 pips out of the market, but how far did this move go? Maybe 50, maybe 60. Once you've got that, 10, 20 times recorded after you do your post analysis of your trade, you can be in a position where, hey, you know what? Instead of taking 20 pips or 30 pips out of the market, I'm going to attempt to take 50 or 60 now. What does that do? It reduces the amount of trades that you take, but increases the win potential of your trades, which means you're now in a position where you're doing minimal movement, but greater returns in the market. I mean, if you're not collecting any data, how do you know that information? How are you gonna gather that information? And how do you know your sweet spot as a trader? You're not gonna.